October 10th, 2025. A date that's already burned into crypto history. What started as an ordinary Friday morning turned into one of the darkest days the digital asset market has ever seen. A day that would later be branded Black Friday for crypto. In less than 24 hours, over $19 billion in leveraged positions were liquidated. More than 1.6 million traders were wiped out. Bitcoin plunged over $20,000 from its highs, and entire portfolios evaporated in minutes. What caused it? A single post, one message on social media, and a market built on leverage, greed, and fragile confidence imploded like a house of cards. But to understand how this happened, we have to rewind a few days. In early October, euphoria was at an all-time high. Bitcoin had just broken new ground, crossing $126,000. Crypto Twitter was buzzing with talk of $150,000 targets, and leveraged traders were piling in, convinced that this bull run had no brakes. Yet beneath the surface, the foundations were cracking. A quiet but escalating geopolitical storm was brewing between Washington and Beijing. On October 9th, China announced new export controls on rare earth minerals, a move seen as a direct threat to U.S. manufacturing and defense capabilities. Rare earths are the lifeblood of tech and weapon production, and Beijing had just turned off the tap. The very next morning, President Donald Trump fired back. In a fiery post on Truth Social, he threatened a massive increase in tariffs on Chinese goods. Markets immediately felt the tremor. Volatility surged, and Bitcoin, often seen as a hedge against chaos, briefly wobbled but held above $122,000. But a few hours later, Trump sent a second post, one that detonated like a bomb. He announced a 100% tariff on all Chinese imports, effective immediately. Within minutes, the entire crypto market went into freefall. Bitcoin plunged $3,000 in a single heartbeat, triggering a chain reaction of forced liquidations. By evening, Bitcoin had touched lows of $104,500, and some exchanges reported spikes as deep as $102,000. Ethereum lost 21%. Solana, XRP, and Dogecoin tanked between 20 and 30%. Cardano, Chainlink, and Avalanche fell as much as 40%. This was not a correction. It was a collapse. So why was it so brutal? Because the market was over-leveraged to the edge of insanity. Just hours before the crash, Bitcoin open interest hit a record $94 billion, a skyscraper of debt built on top of a mountain of greed. When Trump's post hit, it wasn't just fear, it was physics. The domino effect began, long positions were liquidated, prices fell, triggering even more liquidations, feeding the machine in a self-destructive loop. To make matters worse, liquidity was thin. It was a Friday afternoon, when traditional markets were closing and trading desks were shutting down. Exchanges froze, order books jammed, stop losses failed. Binance, Coinbase, and Robinhood all suffered outages, trapping traders in positions as the floor fell out from under them. The crash turned from a market event into a systemic meltdown. But here's where things get strange. Many traders noticed irregularities on the exchanges themselves, behavior that didn't quite add up. Funds were moving in bizarre patterns, withdrawals were delayed, and large sell orders appeared across multiple centralized platforms, almost as if someone was orchestrating the panic. What happened on October 10th wasn't just a product of geopolitical tension, it was a perfect storm, part political shock, part technical failure, and, if some traders are right, part manipulation. Across social media, traders began piecing together clues that pointed to something much darker, a coordinated series of exchange-level moves that amplified the sell-off. And that's exactly what we're going to explore in today's video. We're going to break down the claims, the data, and the suspicions, from exchange manipulation to insider trading, and even whispers of whales coordinating with political insiders. And we'll bring in insights from on-chain experts like Willy, who's been tracking wallet flows and exchange data since before the dust even settled. The question now is, was this the end of the bull market, or the final shakeout before the next leg higher? Before we dive in fully, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell for more deep dives from experts. Thanks, and enjoy the video. The first tweet we will examine in this video reads, "How is Binance manipulating the market? Here is how Sleazy pulls it off every time. Trigger fake sell orders and volume across large coins on their exchanges, simultaneously dump customer funds, transfer, and sell them across multiple CEXs to create an illusion of mass selling." This post from ETH Profit came 2 full days before the crash, and in hindsight, it reads like a prophecy. According to this trader, Binance's internal systems were being used to simulate panic before any real sell pressure appeared. If true, that means the seeds of Black Friday were being planted days before Trump even posted. In a follow-up post, the account added, "All other exchanges see massive inflows during dumping, because in real selling situations, customers deposit their funds to be sold. Somehow, for Binance, it's the opposite. Their exchange sees no inflows, but rather outflows to other exchanges. And guess what? Withdrawals are always delayed across all coins on Binance during dumping. Why? Because they need to buy back your coins before giving it back to you." This second post raised even more eyebrows. ETH Profit wasn't just suggesting internal manipulation. They were accusing Binance of using customer assets to manipulate markets and then locking withdrawals to cover tracks. A serious claim, one that would gain traction once the crash began. On October 10th, short after the brutal carnage began, a widely followed trader on X, DeFi Weimar, tweeted, "Breaking! Binance is dumping millions of Bitcoin and Ethereum to liquidate longs. Pure exchange manipulation." At the height of the liquidation wave, this post spread like wildfire. Traders across X began sharing charts showing sudden synchronized sell-offs across multiple pairs, but originating from one main source, Binance. Coincidence? Maybe. But timing? Impeccable. Hours later, he tweeted a similar accusation against Binance, noting that the exchange was manipulating the market, over and over again. By the next day, markets had somewhat stabilized, but accusations hadn't. Many traders pointed to these repeated dumps as signs of artificial price suppression, a mechanism that benefits exchanges with deep short exposure or insider positioning. DeFi Weimar tweeted again, this time accusing Binance of pumping to liquidate shorts. His tweet reads, "Breaking. Binance just started pumping millions into Bitcoin and Ethereum to liquidate shorts. Yesterday dumping, today pumping. Pure manipulation." Yet, others insist this was all Donald Trump's doing, particularly because of his October 12th post on Truth Social that reads, "Don't worry about China, it will all be fine." Highly respected President Xi just had a bad moment. He does not want depression for his country, and neither do I. The USA wants to help China, not hurt it. When you combine suspicious exchange behavior with record leverage and a geopolitical trigger, you get exactly what we saw, the biggest liquidation event in crypto history. With markets in disarray, the trillion-dollar question now is, what happens next? Can Bitcoin and altcoins bounce back from this? Let's begin with what's encouraging. Despite the turbulence, Bitcoin successfully defended the crucial $100,000 support level. After briefly slipping below $112,000, it swiftly recovered and has since found stability between $112,000 and $115,000. This price action indicates that the crash was largely a derivatives-driven leverage flush rather than a collapse in spot market confidence. In fact, on-chain data reveals that institutional players viewed the chaos as a prime buying opportunity. BlackRock's spot ETF reportedly accumulated more than 21,000 Bitcoin during the sell-off, while XRP whales added over 1 billion tokens to their holdings. All of these points to one conclusion: institutional conviction in the long-term bull market remains strong. The underlying fundamentals haven't changed, only sentiment and excessive leverage have. The dust may have settled, but the wounds are still raw. This event has brutally reset the market, wiping out months of speculative leverage, clearing out excessive greed, and leaving behind a leaner, more cautious foundation. It's the kind of purge that often marks the turning point in every bull cycle. Still, not everyone is convinced the recovery will be smooth. Altcoins, in particular, are looking fragile. Many have lost 30 to 40% of their value, and the altcoin season index, a measure of when altcoins begin to outperform Bitcoin, has dropped sharply to 44, well below the 75-point threshold that typically signals a true alt season. And yet, some analysts argue this pain is precisely what the market needed. On October 10th, Ash Crypto tweeted, "Last time altcoins dumped minus 50% in a single day was during the COVID crash of March 2020. After that, we saw a massive alt season of 2021. We are seeing the same minus 50% dump in alts in a single day. If history repeats, we will see a mega alt season next." Louis Sykes, a senior crypto analyst, also tweeted, "Altcoins have underperformed Bitcoin throughout the entire bull market. That changes today. What better way to kick off the altcoin season everyone's been waiting for than by liquidating everyone before running it up?" Sykes and Ash Crypto believe this crash was a necessary cleansing. In their view, markets often use extreme events like this to shake out weak hands, removing over-leveraged traders before the next phase of capital rotation begins. According to them, this could mark the true beginning of altcoin season, the moment when institutional money starts diversifying beyond Bitcoin. But while traders argue over whether this was a crash or a reset, on-chain data tells a more grounded story, one of surprising resilience. That brings us to one of the most respected voices in on-chain analysis, Willy Woo. His first tweet in reaction to the Black Friday carnage reads, "In the wake of the large sell-down in stocks on Friday, on the fears of a 100% China tariff and an escalating trade war, Bitcoin held up okay. Internally, Bitcoin was building a bullish structure with increasing inflows, which likely shielded it. So far, the flows are holding up okay. On the shortest tactical timeframes, there's likely a little more time, say 24 to 48 hours, before we confirm a local bottom and regroup. So far, it doesn't look like investors are profit-taking. SOPR has not rolled over. That's another healthy sign." Here, Wu references SOPR, or Spent Output Profit Ratio, a metric that tracks whether investors are selling their coins at a profit or loss. When SOPR remains steady, it means long-term holders aren't panic selling, a clear indication of confidence. According to Wu, that's exactly what's happening. Retail traders may have been wiped out, but the conviction holders, the ones who matter most, haven't flinched. His final tweet reads, "So far, with only 1.5 days since the stonk sell-off, Bitcoin demand is holding up. The macro structure, bullish with cracks forming, remains intact. It'll be important to watch if this deteriorates in the coming days. Stocks sold off heavily. Typically, it takes many weeks to regroup." Wu's conclusion is cautiously optimistic. He acknowledges the cracks forming in global markets, especially after the violent stock sell-off triggered by Trump's tariff threat. But he maintains that Bitcoin's macro bull structure remains intact. This means that despite the $19 billion liquidation and a near $20,000 price drop, Bitcoin's long-term trajectory hasn't been broken. If anything, the crash may have flushed out short-term froth and prepared the market for a more sustainable climb. What happened on October 10th wasn't just another crash, it was a wake-up call. A brutal reminder of how fragile this market still is, even after 15 years of evolution. For all the talk of decentralization, a single post, a handful of whales, or one malfunctioning exchange can still send billions of dollars into oblivion. Even as accusations swirl around Binance and whispers of insider trading continue, on-chain data suggests the real story is still unfolding beneath the surface. Whales are repositioning, smart money is quietly reaccumulating, and the same structural flows Willy Woo highlighted, those steady inflows into Bitcoin, are what have historically preceded every major rebound in this asset's history. Real Vision CEO Raoul gives the best conclusion to the entire event in a recent tweet which reads, "All said and done, regardless of what sparked it, Friday was a flash crash. Flash crashes usually recover in V-shapes back to their prior price dodge range and usually go on to make new highs shortly after. In this case, we entirely wiped out all accumulated leverage too. Higher. Maybe this isn't the end of the bull market. Maybe it's the cleansing event, the final capitulation that shakes out the gamblers before the next leg higher. Or maybe, for the first time, we're staring at a macro landscape so unstable that even Bitcoin's resilience will be tested. Either way, this week marks a turning point. The question isn't whether crypto will recover, it's who will still be standing when it does. Because history has shown every great bull run begins where fear peaks. And if this really was Black Friday for crypto, then what comes next might just be the rebirth of a stronger, smarter, and more battle-tested market. So, what do you think? Was this the beginning of the end, or the flush out before the next Bitcoin rally? Drop your thoughts in the comments below. If you found this breakdown helpful, make sure to hit that like button, subscribe, and turn on notifications, because in the coming days, we'll be tracking every new move from the whales, the exchanges, and the policymakers shaping what could become the most important crypto chapter yet. Thanks for watching.